When a bank lends money, they don't just hand you cash. They attach conditions. Those conditions are called covenants. A covenant is a financial rule your company must maintain. If you break it, the bank can freeze your line of credit or demand repayment. One common covenant is the current ratio. Current ratio equals current assets divided by current liabilities. If your bank requires 1.20 and you drop below that, you're in violation. It means you may not have enough short-term assets to cover short-term obligations. Another covenant is debt leverage, usually measured as total debt divided by EBITDA. If your leverage exceeds the agreed multiple, say 4.0x or 5.0x, the bank sees you as over-leveraged. This is a critical indicator of your company's long-term financial health and borrowing capacity. For companies with a line of credit, borrowing is often based on assets. This is called the borrowing base. Typically, banks lend about 80% of eligible accounts receivable and maybe 50% of inventory. So if you have $1 million in AR, you might only access $800,000, not the full amount. Banks take this haircut to protect themselves against uncollectible receivables or slow-moving stock. Before the loan closes, you receive a term sheet. This outlines the interest rate, covenants, and reporting requirements. Interest is often structured as a base rate, like SOFR, plus an index rate. For example, SOFR plus 2.5%. Remember, reporting requirements are just as important as the numbers themselves to stay in compliance. Here's where companies struggle. Cash inflows and outflows don't line up. Timing creates pressure. You might collect from customers in 60 days, but payroll is due in 2 weeks, suppliers in 30. That's why companies need a line of credit. Not because they're failing, but because timing matters. Profit is accounting. Cash is survival. If you don't manage your cash cycle, the bank will manage it for you. Manage your covenants and borrowing base proactively. And trust me, you don't want the bank stepping in.